Hello everyone, my name is David Andolfatto. I'm in the research division at the St. Louis Fed. And I'm here to speak this morning with Kyle Herkenhoff of the University of Minnesota. We're here at the St. Louis Advances in Research Conference in April 2016. And Kyle has graciously agreed to sit down with us and discuss his paper that he'll be presenting, which is titled, How Credit Constraints Impact Job Finding Rates, Sorting and Aggregate Output. Welcome, Kyle. Can you tell me a little bit about what this paper is all about? Credit constraints impacting job finding rates? What is this?
So we were inspired by the 2007-2009 crisis. There was a large downswing in consumer credit. And when we looked around the profession, we noticed that we didn't have a very good understanding of how job finding rates were impacted by consumer credit limits. So what we wanted to do was build the first data set to bring together how credit constraints affect the job outcomes of households, the wages they get, the types of jobs they find. And the idea was to bring the profession the first estimates of how access to credit, how much mortgage debt they have, how much credit card debt they have affects the types of jobs they take.
So intuitively, do you have any anecdotes? Like how does it, credit constraints, how does this affect the job finding activities of unemployed workers?
So the easiest way when I talk to people about this paper of understanding what we're finding, in general what we find is that credit limits, the more credit limit you have and the more buffer you have in terms of access to credit, the longer you take to find a job and the better fit you find. And the easiest way to understand that is if you run the story in reverse. So you think about being laid off with a large amount of mortgage debt, credit card debt, etc. You either have to find a job quickly or you're faced with the prospect of defaulting, which has severe costs. So the idea here is that if you lose your job and you've got your back against the wall, you've got a ton of debt, you're forced to find jobs relatively quickly that may be lower paying and less suited toward your skill set.
Sure. So you think that there's an ability on the part of recently unemployed workers to access a credit line at the bank, for example, and that the availability of this credit facility helps them in the job search process? Is this the idea?
So one policy implication of the paper would be, yes, if you actually ease credit constraints of workers, if you, let's say when you gave them unemployment benefits, you also handed them a credit card.
Right.
This would allow them to potentially take a little bit longer to find a job and find a job that's better suited to them.
Well, let's back up from policy implications. I wasn't going there yet. What I wanted to know is actually what you found in the data. I mean, do you actually find evidence that, say, recently unemployed households or workers who have access to, say, a credit facility, do they behave differently than those that don't have access to a similar facility?
Yeah, so they do. They behave quite differently. Okay. So what we found is that if you give a worker an extra $1 of credit, it's about the same as giving them an extra 50 cents of unemployment insurance. For people who work in this literature, it's well known that unemployment insurance generally allows you to take longer to find a job and find a higher paying job, especially when you look at US estimates. What we find is a similar effect for credit. So if you give someone an extra $1 of credit limit, they take about, actually the best way to express it, if you give somebody 10% of their prior annual income in terms of credit limits, they can take 2 to 3 more days to a week longer to find a job, and their earnings replacement rate, the wage they find, is about a percentage point higher. Relative to the unemployment insurance estimates, if you give somebody 10% of their prior annual income in unemployment insurance, they take somewhere between a week to 2 weeks longer to find a job, and the replacement rates are somewhere between 0.5% to 1.5% higher.
In the data, so these people that you identify that have access to the credit facility, is this like a line of credit at their bank? Is it a credit card? Or?
So it's a combination of these. So we look at the whole portfolio of the household's credit. So we look at revolving credit in particular, which would be what you're describing as credit cards. Credit cards alone allow households to replace up to 30% to 40% of lost income. And then there's other types of revolving credit that we study, such as home equity lines of credit, other forms that weren't so popular before the big housing run-up.
Okay, so I suppose if you're a worker in a situation you're working, but your credit limit is kind of stretched, and then you lose your job, you're kind of facing kind of a different prospect relative to your neighbor who might have a credit line available.
Exactly.
You're more likely to actually find work more quickly.
Yes.
So in a sense, the lack of this credit facility might actually stimulate the unemployment rate to decline, in fact.
But that's where the second part of the title comes in, which is those people who do take these jobs relatively quickly end up in jobs that aren't suited well to their skills or their abilities. So what we find is that this can actually decrease aggregate productivity quite a bit.
So this is an example of where an elevated period of unemployment might actually be good in some sense.
Yeah, so if you were to see, let's say, should we get into the policy implications?
I think this is a great spot now. What sort of policy implications do you think follow from your findings in the theory?
So the policy implication for an institution like the Federal Reserve is if you lower interest rates and households' credit constraints ease, so they get a lower interest rate on their debt, the unemployment rate might actually go up, but that's not a bad thing in the sense that households are finding jobs and looking for jobs more thoroughly and finding jobs that better suit their ability. So it may be the case that elevated unemployment after a rate decline is not necessarily a bad thing.
What about fiscal policies? And to the extent that, say, financial markets don't work as well as we might like, I mean, do you think there might be a role for the fiscal authority to, I don't know, provide short-term credit for workers in distress who are?
Yeah, so one way to feasibly implement like a lending window for households would be when they walk up to ask for unemployment insurance, we give them, or the Department of Labor gives them a credit card. And that would allow them, I think, the most constrained workers to borrow, and people who have assets and who don't need the credit facility wouldn't use it. So in some sense, it wouldn't be a very costly program, but would provide credit to those who need it the most.
Okay, very good. Credit cards for the unemployed. Thank you very much, Kyle.
Thanks,
Very
Steve.
interesting.